Hello students, I am Dr. Nihar Dhake. Today I am taking a lecture on financial accounting basic portion, that is principles of accounting. So principles of accounting means what? So while maintaining our books of accountings, we have to follow some rules or regulations on which basis you have to maintain your books of accounts. So the rules that is you have to maintain or you have to follow is called principles of accounting, because each and every method is described through the accounting rules. So accounting principles in financial accountings. So what kind of books you have to maintain, by which method you have to maintain, by what kind of guidelines there are, uh, mm, that is mentioned in these principles of accounting. So accounting principles is nothing. It is generally accepted accounting principles. Means what? Globally, this kind of accounting principles accepted. Using these basic principles, each and every country maintain their books of accounts in classifying their books of accounts and providing uh, the particular information. So what is included in principles of accounting? So principles of accounting included business entity principles, going concern principles, consistency principles, accrual basis principles, materiality principle, convertism principle, matching principle, revenue recognition principle, full disclosure principle, and consolidation principle. We are going to take this one by one, so you will be able to understand each and every principle of accounting separately. So let's start. So the first one is business entity principle. So business entity principle means what? So business principle entity or concept states that the business enterprise is separate from its owner. In simple terms, for accounting purposes, the business and its owners are treated separately. Means when you are talking about the business is an artificial person and the owner is the natural person, and both of them are different. So liabilities of business is totally depend on the business have to pay all the liabilities, owner will not be responsible for that. That is called business entity principle. It means business is considered as a separate entity, so that is called business entity principle. The another principle, that is going concern principle. So what is mean by going concern principle? So this principle assume that a business will continue to operate indefinitely unless there is evidence to the contrary. Means what? The principle will continue in their future. It will not wind up or liquidate, or it will not stop doing their businesses. Okay, it will go consistently, and on that basis they have to maintain their books of accounts for near for their future. In other words, financial statements are prepared with the assumption that the business will not be liquidated in the near future. In near future, the business will not close down, and we will maintain all the books of accounts continuously. So that is what going concern principle. It means your business is going uh, regularly, it will not close down in near future, as against if there is a evidence of contrary. Means what? Some false things happen in your business or illegal actions is happening in your business. In that case, your business will be shut down uh, in between the that particular time. Okay, so we are going for the next principle. So that is the consistency principle. Consistency means what? The consistency principle requires that a company uses the same accounting method and principle from accounting period to the next. Means what? If you are maintaining the books of account by utilizing the one method, the same method you have to apply in the next second year, third year, fourth year, and so on. Means you cannot change the method of maintaining accounting each and every year. If you are maintaining one special method for first year, you have to apply this method in second year also, third year also. For example, if you are uh, using straight line method for the depreciation, so that particular method you have to apply in each and every year. Means straight line method also applicable in second and third year. So that is called consistency principle. Means if you are maintaining your books of accounting using one particular method, you have to use that particular method in next year also, second year, third year, fourth year also. That is consistency principle. This ensures that financial statements are comparable over time, making it easier for stakeholders to analyze trends and performances. Means consistency. While applying the consistency principle, you are able to compare the financial statements with each and every year statements. Okay, that's why consistency principle is important. Then accrual basis principle. What is mean by accrual basis principle? Under the accrual basis of accounting, revenues and expenses are recorded when they are earned or incurred. Means what? If you are doing transaction and at that time, if you are getting the cash or not getting the cash, you are just doing your transaction, cash will received in future, but the transaction is happen, means your income is accrued. Or you are spending money, or you are not spending money, but you are doing transaction. For example, if you have purchasing goods from particular person and you are not paying money to him, and you are making promise in future you are going to pay, so that is what the transaction is incurred on accrual basis, because the transaction is accrued. Okay, so income or expenses is accrued at that particular time, so it is called accrual basis principle. Means if the cash received, if the cash received or not, either cash received or not, the principle, accrual basis principle said what first happened, you have to make sure of your accounting on that basis. If the cash is received, mention in your books of accounts. Either cash not received but transaction happened, mention in your books of account. This principle helps provide a more accurate picture of the company's financial performance and obligations. Okay, so going to the next principle, that is materiality principle. This principle states that financial information should be disclosed. If omitting it would affect the decision of financial statements user. Means as per this principle, if there is a particular decision or particular thing which is affecting a financial statement, then you have to disclose it. Or if it's not a bigger issue, if it's not a impact on your financial statements, then you can there is no need to disclose it. So as per this principle, financial information should be disclosed. Means which financial information you have to disclose? If omitting, it would affect the decision of financial statements. Means if you are omitting that particular information, it will affect the decision of financial statements. So you can say that if there is a particular transaction for rupees 10 lakh which is happened, but I omitted that particular transaction, means I didn't mention in my financial statements, and due to that the decision of the financial statement will be affected. So I have to disclose that particular transactions in my books of accounts. But if there is a transaction of 500 rupees which could not affect my financial statements decision, in that case there is no need to disclose that particular 500 rupees transaction. So that is materiality principle. Means what? Materially affecting the financial statements, you have to mention in your books of account. If materially it's not affecting your books of accounts, there is no need to mention in your financial statements. Okay, so next principle is convertism principle. So convertism principle means what? Also known as the prudence principle. This guidance suggests that when there is a uncertainty in the account estimates or the valuation, accountant should err on the side of caution. Means if you are not confirm about what is happening, what will happen, expenses will happen or income will get or not, bad debts are there, or income, some compensation we have to paid in future to our employees. So we didn't know about something, that in that case you have to make accounting on the side of caution. Means if there is a losses or liabilities, you have to take in consideration as soon as it possible. But if we talk about the profits or unrealized income, then you don't have to take in accounting earlier. When it will happen, then you can take into your accounting. Okay, so that is called convertism principle. Means when the transaction happen, so transactions going to happen. So if it is affecting, then it is losses or liabilities, you have to insert in your books of accounts as early as possible. But if it is related with the gains or uh, profits, then you can uh, keep it outside until they realize. Okay. Then matching principle. So next principle is matching principle. The matching principle requires that expenses should be recognized in the same accounting period as the revenue they help generate. Means if you are making some expenses and from that you are generating revenue, so it should be maintained in your books of account in that particular period when you are generating income, and for that making expenses, it should be given or it should be mentioned in that particular period, particular year when you are spending the money and earning profit from that spended money. Okay, so the matching principles, what is saying, you should be recognized in the same accounting period the revenue they help generate. Means which expenses you are making, and from that the revenue you are generating, it should be making in the same period. This ensures that financial statements accurately reflect the cost associated with the generating revenue. Okay, so the next principle is revenue recognition principle. Means what? This principle outline when and how revenue should be recognized. Generally, revenue should be recognized when it is earned and realized or realizable, and when the goods or services have been delivered or are substantially completed. Means what? The when revenue should be recognized. So revenue when we will recognize if the revenue are realized or realizable. Realized means what? You are selling goods and you are getting the money in cash form. That is realized revenue. And realizable means what? If you are selling goods and selling goods on the credit basis, so you will get money after 2 or 3 months. It is realizable basis. So revenue recognition principles say that when the revenue should be recognized when it is earned and realized or realizable. So you can say that revenue recognition principle, and when the goods or services have been delivered or substantially completed. So after getting money, if you are delivering your goods or services and delivering them to your customers, then the substantially complete your transaction, then the revenue recognition principle works. Means what? You are selling goods and taking money advance, and when you deliver the goods, your transaction is completed. That is called revenue recognition principle. The next principle, full disclosure principle. What is mean by full disclosure principle? In full disclosure principle, you have to provide each and every information to the stakeholder of your business. Means the full disclosure principle what says? Requires that all significant information relevant to the financial statement should be disclosed in the footnotes or supplementary schedules. Supplementary schedules or footnotes means what? If there is not particular space related to particular item in your books of accounts, so you have to provide the proper information about that particular item. So you can give the footnote in uh, at the downside of your financial statement. So even if it is not directly presented on the face of the financial statement, in that case, the stakeholder will able to understand what you are trying to say by using that particular statement. So full disclosure principle means you cannot uh, keep information from your customers or stakeholders. You have to disclose all the information related to your business, your financial accounting, financial statements to all your stakeholders. And consolidation principle. So what is consolidation principle says? When you have more than 2 or 3 companies, you are parent company, you have another two companies. So you have to consolidate the financial statements of each and every company and present it in a one format, single format. So all stakeholders of your company is able to uh, get the information about that particular uh, pro forma of that particular company. Means if you are a ABC Company Limited and you have under A Company Limited, B Company Limited, C Company Limited. So you have to consolidate all the accounts of A, B, C and ABC Company Limiteds and make a consolidated financial statements using which each and every stakeholder able to understand the financial security, financial statement, financial situation of your company. Okay, so that is consolidation principle. And thank you very much for listening or attending my lecture. Thank you.